Traders, how you doing? It's Matt. It is October 6th, 2022. And I just had a great session with one of our traders and realized we don't really have um, any content on what we discussed. And I wanted to kind of take you through it. So it was a discussion on economics. And I don't really I've told several of you I don't read economic news. Um, when I trade, I go straight into the charts, right? I let the chart tell me what I'm going to do. But that isn't to say that um, that knowing what's going on or knowing some basic economic background information and how it relates to foreign exchange isn't helpful. You've probably most of you have probably been on trading sessions with me at night when I pull this chart up or this web page up, and it's the futures. So what are the futures doing overnight? Because that usually tells me, okay, what can we expect as far as currencies? What are currencies going to do based on what's happening in the futures market? And it also applies during the day, when the stock market's open. But you can see that the stock market today, the Dow is down 377 points, so a little over percent, and it continues its descent. So what does that mean for currencies? Well, if we go to our baskets, we can see. Okay, so I pulled up the baskets here, and the gold in this chart is dollar. The green is yen, and this purple is the Swiss. So I was explaining to the trader I was just meeting with that where's my drawing tool? Well, I'll just put it in text. So when the market is tanking like it is today, so market down, there are certain safety currencies. Safety is not spelled with a G anymore. They changed that. They are the dollar, the yen, and the Swiss. Okay? Now, those are the safety currencies. So when the market is tanking, we can plan on, or we should see, at least one of these rallying. It's a flight to safety mechanism, right? It's like when the market's down huge, people buy gold. And don't even get me started on that. I'm not going to discuss that without getting angry. Um, and then there are growth currencies. These currencies rally when the market is rallying. They are the Aussie, Kiwi, and the CAD. Wild cards are, of course, the ones left, Euro and the pound. Right? So right here, this is the dollar, the yen. This is the Swiss right here, the purple. So we see the dollar really rallying. Now, what happens to the growth currencies when the market is tanking? They decline. They tank as well. So down here, this is the Kiwi, the white. The blue is the Aussie. So we can see that's working out. Now the one that doesn't really make sense is the CAD. But the CAD is also tied to what? Exactly. So in the wild cards, the euro, the pound, they operate independently of what the market's doing. But this is kind of the structure with regards to the stock market. So the stock market can kind of give us a sense of what's going to happen with currencies. That's why when I'm on a trading session at night, I always pull this up to see what's going on with the futures trading that happens overnight. But, obviously this trading is live, and, it looks like we're still declining, which would explain the two safety currencies, yen and dollar, rallying, and two growth currencies, Aussie, Kiwi, descending. And that's been going on for a while now. So I wanted. Then we started talking about, why would someone trade Aussie Kiwi, right? If they're both growth currencies and they both decline at the same time, why do people trade that pair so much? Also, why do people trade dollar yen so much? And so I pulled up a chart, pulled up the dollar yen chart. This is a daily, so for me, this is unheard of that I go to the daily chart. But we looked up when, so we can see that absent any fiscal changes within one of the countries, Japan or the US, this pair trades in relative parity, as you can see here. Now, what happened in March? What happened in March this year? Well, I think we all know. The Fed started to say, we're going to raise rates, and we're going to raise rates more aggressively than we thought we would. So for a currency, that's very good. If the Fed says, hey, I know we said we were going to raise rates a quarter point, but it turns out we're going to raise it 1 point. Well, following that news announcement, you're going to see a huge spike in the dollar. And that's what we've been seeing ever since March. Now, he and I pulled up, let's see, we pulled up a couple of these numbers, and this is why. Inflation rate year over year, 7.9%. Now, I know we're not all economics majors, but some of us are, and these are really high. Usually, inflation tends to be anywhere from 2 to 5% a year. 5 is a little on the high side, but 7.9, that's high. So what does our Fed have to do to rein this in? Well, they have to raise rates, because this is showing us that there's too much money in circulation. Core inflation, it just shows that things are being priced higher and higher because the population as a whole has more money in its pockets. Now, we'll get to some of the problems with that simplistic view. PPI, that's not bad. Month over month, less than expected, less than the prior month. But as I went through some of these, I was thinking, okay, housing starts. That may not look like much. The forecast was 1.69, actual 1.769. That's actually a lot. So what that was telling the government, and building permits, again, higher than expected. What that means is people have more money. And this is where we got into the Fed interest rate decisions. And yes, this interest rate was expected to be raised by 0.5%. But the hawkish comments in the FOMC minutes was the reason for this rapid ascent. And then, we can see, we looked at, what else did we look at? We looked at CPI, Consumer Price Index, and we looked at PPI, Producer Price Index. Producer Price Index is how much companies are spending to make the things we buy. Now, obviously, they want to pass that on to the consumer. So as PPI increases, so should CPI, Consumer Price Index, what we're paying in stores for those same products. And sure enough, we saw that those numbers were increasing. Anyway, I wanted to show him, why all of a sudden the dollar and the yen had decoupled with regards to, their parity that we had seen. See, look at this parity. Yes, there are micro trends in here. Yes, we want to trade those. But if we, and then if we want to take it shorter, look at the range. Not very far. These pairs trade in parity unless the Fed comes out and says, oh, we're going to be aggressive in raising rates, way more aggressive than you thought. Well, then the dollar spikes. Same thing would have happened if the Japanese bank would have come out and said the same thing. Then we'd have, a tug of war going on the way up. But they didn't. So this is what happens. This is why the dollar has been on such a tear. And it's not just today's market descent. That's just today's result. But overall, this is why the dollar in relation to the yen, which they're both safety currencies. So why did one break out so much against the other? Well, we know why. The Fed and raising rates. So that, as a rule of thumb, if a country comes out and says, we're going to raise rates faster than expected, that's a hawkish statement, as opposed to a dovish statement, which says we're going to lower rates or we're going to raise rates slower than expected. That's a dovish statement. So hawkish means the currency is going to rally, is going to spike. Dovish, other way. That's all you need to know. don't try to make sense of it. Doesn't matter. It's like one of those other things I talk about. Does it really matter why? No, because we're traders. We don't care why. We just care what's going to happen. So we can trade it and make money. Anyway, you can see, and I posted on our Discord last night that, I mean, last night was a mess as far as trading was concerned. Let's see where I got it. Yeah, this was about where I got caught up in here. Nope, this was right here. So, occasionally you'll see the blue is the Aussie, the white is the Kiwi. So occasionally they will decouple, but then they always seem to come back in lockstep, and now they're both, two of the three bottom performing currencies, along with the pound right now. Again, the Dow still negative 1.2%. So we have our safety currencies up here. The Swiss is another safety currency, but we shouldn't always expect that every safety currency is going to rally when the market tanks, nor should we expect that every growth currency is going to tank when the market tanks. Thus, the CAD. That's the CAD right there. And it's above the Swiss, actually. And the euro and the pound, wild cards. Anyway, I wanted to show you guys that. Just so you're watching these announcements more closely. There's a website also, forexfactory.com. If you go here, it will typically show you what will happen. So employment change, this reflects on the CAD. So if you go in here, just look for the usual effect section. Actual greater than forecast is good for currency. That is the typical answer. In very rare circumstances, is it the opposite? And I can see one right there. Actual less than forecast is good for currency. So anything oil related, natural gas related, it's the opposite. But the typical rule of thumb is greater than forecast, good for currency. So rates, greater than forecast, good for currency, like I just was talking about. Employment change, actual greater than forecast is good for currency. Unemployment rate, this is one of those exceptions. Actual less than forecast is good for currency. So this is a great resource to have, forexfactory.com. And we can see these announcements coming up in TradingView. It's a setting you can set. And if we go up to Aussie CAD, CAD had IVPMI at 8 o'clock this morning. So if we go back up to 8, right there it is right there, IVPMI. This is the actual forecast, previous, actual greater than forecast is good for currency. So this is a good way to tell what's coming up and what to expect given what numbers come out versus what's forecast. Now, the reason I don't do much economic analysis is because I don't know what's expected. There's a market expectation that I don't know. $7 trillion a day trades in this market, and all of the participants, they don't talk to me anymore. Not all of them, right? So it's very hard for me to get a grasp on what the market expectation is. So all I can do is trade what the reaction is. If the market expectation is that the Fed is actually going to raise 3/4 of a point next Fed meeting, but the forecast is 0.5, well, some people would think, oh, that's going to send the dollar just skyrocketing. Is it? Not if the expectation is at 3/4. No. In fact, it'll probably go down. That's why I don't take any expectations into a chart. I don't take any previous biases into a chart because I do not know what the market is expecting. All I can do is react to the market and its and the price action of any pair. So that's why I've told you, if I've spent 5 minutes on economic analysis today, it's 5 minutes I want back, honestly, because everything you need to know, you can see in the chart. Everything. Because this is where you're making money, not reading economic analysis. That's not where you're making money. Because I promise there are a million people doing that. And it's determining the expectations. But to what extent? How many of the large market participants are gaining their expectations from that market analysis? We have no idea. The calling tree failed a long time ago. So let's just go by what the chart says, right? Anyway, just wanted to share this brief economic analysis with you. It's probably one of the few that I will do, but I figured it was important enough to share. Different safety currencies, growth currencies, wildcards, and given the market's continual downtrend today, we can expect to see two of the safety currencies up there. And we can expect to see Aussie and Kiwi down here. All right, guys. Thanks for listening. We'll talk to you soon.